Welcome back to the Sense of Security podcast. I'm Cassidy Clement, Senior Manager of SEO and Content at Interactive Brokers. And today, I'm the host for your podcast. Our guest is Steve Sosnick, the Chief Strategist here at Interactive Brokers. And we're going to be talking about how markets react around election time. So, with election time just around the corner, it's important to understand how this will impact the market. If you're looking to adapt your strategy or you're researching the political impacts on the markets, we're going to try to explain some of the foundational topics and then some of the others that are crucial to expanding your knowledge in this area. Welcome back to the program, Steve.
Hey, Cassidy. Great to see you again.
Yeah, so just to kick it right off, we're getting into the nitty gritty of it. It's fall. It's a presidential election here in the US around the corner. But the big thing that people always talk about is volatility in this time. It's what's happening around the volatility within this election or around these elections. And we don't even have to get into politics to even really talk about that. Most people, when you ask them this, they almost go, well, it depends. A leads to B, and et cetera, et cetera. So, what's your take on the volatility around these election times?
Well, it depends.
Right.
Um, you know, there are so many factors because no presidential contest is exactly the same, and that's why it's sort of hard to generalize. One of the things that's notable is that markets have been pricing in a little extra volatility around the election pretty much for the whole year. And without getting too esoteric, many of you are familiar with the VIX, the SIBO Volatility Index. And one of the things to keep in mind is that index has futures on it. And so the futures that expire in mid-October have had a persistent bump, a persistent extra volatility priced into them. The reason why I say mid-October is it's important to remember what VIX is. It's meant to measure the volatility over the ensuing 30 days. So the election in early November is within the 30-day period from the middle of October. So that's where it got priced in that manner. But it's interesting because we really didn't see a lot of people trading in those VIX futures. It wasn't an abnormal amount of trading. It was just more of the market playing defense a little bit and saying, yeah, it's reasonable to expect a little more volatility, but we didn't actually see a lot of trading in those futures or a lot of what we call open interest, which are existing positions in futures trading around there. That has since started to pick up, but that's just natural because as we're approaching mid-October, literally, we're in late September as we're taping this, it's normal to see that maturity of future pickup in trading. But it's hard to say how much of it is election driven now, but certainly before, I would say it was more market anticipating more volatility. What I would say in the case here is it's reasonable to expect some volatility because this is certainly one of the closest races in a long time. There have been some changes in leadership. Vice President Harris's campaign has been picking up a little momentum, but every time you see a poll that tells you one thing, there's another poll that tells you the opposite. So realistically, it's essentially a coin flip. When you have a coin flip, it means there's not a lot of consensus. On the plus side, the most volatile trades occur when a consensus is violated. If everybody thinks something is going to happen and the opposite occurs, well, then there's huge volatility because everybody's caught off sides. In this case, it's a paradox because nobody knows what to expect. There's actually not a lot priced in. People really haven't made a ton of investments one way or the other based on the election outcome because it is so difficult to call. In many ways, it defies conventional wisdom because you'd think if any event is too close to call, it should therefore create more volatility because half the people are wrong. But in this case, nobody's really done anything about it. So, from a market point of view, at least as of late September, there's not really a market consensus to be overturned by a presidential outcome one way or the other.
Yeah, that's kind of the biggest point right now, at least when we're talking about volatility to general consumer behavior or market trends, if you will. It's almost an indecisiveness. And that kind of leads me into my next question, which is, are markets likely to perform better or worse when you're coming up on an election time. And I say that with fully knowing that strategy and research that goes into your investments has to be way more than who's going to win an election. I speak for many millennials when I say the word unprecedented has been used to describe a majority of the events within our life so far. And it feels like we're in another one of those. So I think it's an interesting question to address. Maybe in the past, markets performed better or worse up to an election. But, what do you think about that trend? And do you think that that's going to continue to happen? Or do you think it's kind of just going to teeter like it's been?
In theory, uncertainty should impede markets. In reality, it's about so much more. I've had this conversation various times with people, both investors and in the media, and they've said, well, the election, it's certainly the most important thing out there. And it is if you live in the US. I mean, it really is. It's going to impact how we live our lives over the certainly the next 4 years and possibly beyond. But in terms of from an investing point of view, which is really what markets get into, it's not clear how it's going to impact a wide range of investments. So yeah, it should provide a little bit of a damper because we do have all this uncertainty, and uncertainty impedes one's confidence. And if your confidence is impeded, you may be a little more reluctant to buy. You may be more willing to lighten up on positions. So in theory, it should provide a little more volatility and a little bit of a headwind for the market. But in reality, I defy most people to tell me exactly how the election will impact many of their favorite companies. There are certainly industries and certainly companies that would and could benefit from such a thing from an election. Among the sectors are energy, where a Republican administration is certainly viewed as being more energy friendly, despite the Democrats' assurance that they won't be energy unfriendly. And frankly, under a Democratic administration, there's never been more oil pumped, as there is now. You can argue the inverse for green stocks, where the Republican platform is not particularly friendly toward any mention of climate change or green energy of that sort. While the Democratic platform is certainly much more in favor of that. But again, even there, Texas, which is a very Republican state, top to bottom, is one of the largest producers of renewable energy. So there's no real clear cut yes or no. One thing that's out there actually that does impact things, and there is a historical preference for this and a historical bias toward it, is when markets tend not to love it when one party controls all the levers, meaning you have the president, the House of Representatives, and the Senate majority all being from the same party. I defy anyone who can tell me if that's going to happen now. If essentially all three of those races are toss-ups, you could pretty much come up in a random number generator, but odds are if all of them are toss-ups, it's very hard to see them all, shaking out in exactly the same way, barring some change as we get closer to election day, the October surprise, as it were. But that's really about it. Just to pick a random company, are you going to buy or sell McDonald's based on what happens in the election? I defy you to tell me how that really changes in early January when a new president is elected. So that's just one of many examples. It's really, in many ways, better to keep your politics out of your investing mindset because it's not necessarily relevant to the vast majority of companies that matter.
So, on that note, when we start to look at it from a little bit more of a macro perspective, broader markets, right? What are some examples of some market events that maybe happened around an election or because of an election that can serve as some examples? Obviously, as you said, there's a million other things that can impact your investments. But as somebody who remembers, 2008's election, 2016, 2020, all of those where it was big turning points. And at the same time, you also had different financial flips or a crisis or a recession, etc. What are some of those examples that our listeners can use to kind of identify a little bit of an understanding of how elections can impact the markets or should be taken into consideration when defining a strategy?
understand that it's incredibly unpredictable. And the example that comes to mind is 2016, which was a very close race where the popular vote and the electoral college went in different directions. And that was because of some very tight races in a few specific states. And the initial reaction of the market was completely upside down. Once it appeared that Trump had defeated Clinton, the first reaction of futures, particularly aftermarkets, was to trade lower, sharply lower. By the end of the next day, the markets closed sharply higher. So conventional wisdom is not always right or wrong. And it's not even as simple as Republicans good, Democrats bad, or vice versa, because the track record is incredibly mixed in that regard. If I'm going to offer a lesson today, don't stress too much over the election, at least as far as your investments are concerned. Do whatever you want to do politically. Please go vote. But, from an investment point of view, I'm telling you, a lot of the most experienced professionals don't know what to do, and as a result, are not doing much as a result of it. It's very difficult, to say to a newer investor, "You should do this or you should do that." It's in many ways easier just to sort of say, "This is out there, be cognizant of it, know that it could shake things up," but it's really, really difficult, if not impossible, to say, "You should do this because the election might turn out with such a scenario."
What I'm going to bring up next does kind of rely on the predictability of scenarios, but we're going to explore it anyway because anybody out there doing any type of election research is going to come across this. It's the presidential election cycle theory. So I know there's caveats with this. So if you would like to give our listeners a little bit of a definition. I know we're coming to drive the point home. Hey guys, there's a lot more than just what you see on TV or what you read online to how this is going to impact the larger scale market. But, this is something that gets referenced pretty heavily, especially every 4 years.
Yeah, the electoral cycle, it's a lot like seasonality, and I'm sure you'll drop a link in here to the podcast that you and I did about seasonality, and they're related. I mean, things often tend to move in cycles. The theory basically says that markets tend to do better in the first year, maybe the second as well, of a presidential term. There's a little bit of a honeymoon period. They tend to slag off a little bit in the third year because usually, nothing gets done because it's typical for the incumbent presidential party to lose seats in the House and the Senate. And so you get mired into more gridlock. Then in the fourth year, you get promises thrown at you. So the market tends to like that too. Remember, of course, markets do tend to go up, but there's no hard and fast rule to this, especially now that we're in what I'm going to say is a much more dysfunctional political era. Things that used to work politically just don't anymore. So the idea that that's something that's tended to work over time with, some general predictability, but far short of a statistical certainty or even a statistical likelihood is going to persist now. It's really hard to say. I do think a lot of it has to do with specifics. So, for example, 2017, the market rallied because the market was enamored with the idea of tax cuts. That was the discussion pretty much the entire year. And certainly those investors with the most money to invest in the market got the got the bulk of the tax cuts, but that's very market friendly in a sense. And then, 2018 we had some big shocks actually, which was the second year. The third year of the presidential cycle was 2023, and that's supposed to be your bad year, and the market was just fine in 2023. It's a great year for markets. And going into the election now, obviously, this has been a good year too. So these things are sort of general guideposts, but in reality, as with all seasonality, as with all sort of cycles, there's a general logic to them. There's a general sense that they tend to play out the same way over time, but there's no reason for them to play out systematically the same way over a period of time, whether it's the business cycle, whether it's seasonality, whether it's a presidential cycle. Human nature tends to work in patterns, but also human nature, more importantly, tends to be unpredictable. So when you're based on human nature, general good feelings, that kind of thing, psychological factors, that's almost, it's really difficult to predict.
It's really hard also if you're just getting started in your investment journey in this time, because you're going to have an extra layer of overinformation, noise, if you will, when it comes to news, a lot of short term outlooks that are part of your research instead of more of a long term, as you were saying, like kind of, hey, you can kind of do what you're doing here. You just have to factor this into the strategy. It can't be the whole strategy. And then also, you have a lot of people trying to time the market perfectly with trends that they believe are trends and not necessarily what is seen at a broader scope. And that kind of references back to that cycle theory, that presidential election theory. I mean, it's looking at years and years of presidents and saying, hey, wait a second. At some point in their term, they're like, hey, I got to boost this economy and I have to try to get reelected. It all makes sense. You want to look good, you want to make sure you get the votes again. But it all comes down to doing the right amount of research, in my opinion, and probably looking at things from a little bit of a broader scope, taking in a lot more ingredients than just one. I mean, from your perspective, what are some things you would tell investors to keep in mind if they were new to the space, just entering the investment journey, and it's November?
What I'm never going to do is say, if you really have a very well thought out plan, I'm never gonna tell you not to try it, okay? So that's important. The caveat there is there are a lot of professionals who've been doing this for a long time who don't have a lot of clarity on this topic. That also means if there's no clarity, there's sometimes room for being able to maneuver in a way that no one else has. Again, so that's why I'm not gonna tell people not to think this through. I'm not gonna tell people to ignore it. I'm not gonna tell people to not come up with, with their best assumptions of what might transpire and how the market might react to it or how specific stocks might react to it. But I think just basically saying, you know what, I've been following this stuff on Twitter and this politician or the other is saying this or that, and it's good or it's bad. It, markets are really investors in general are really horrible at geopolitics. My point here is when you take a situation like elections, which are inherently difficult to predict, unstable in terms of outcome, and have a very nebulous effect on the vast majority of companies and their stocks, and therefore the market as a whole. Don't read too much in don't let the election influence your decision too much one way or the other because of all the factors I just laid out.
Yeah, I think that's kind of the big point here. It's an event that needs to be taken into consideration, but it shouldn't be the only thing taken into consideration. But we cover some great points here. Hopefully everybody listening is keeping tabs on what the market's doing and how the election's impacting it. But you covered some great stuff, Steve. Thanks for joining us.
My pleasure as always, Cassidy. Talk to you again
Yeah,
soon.
thank you. So, as always, listeners can learn more about an array of financial topics for free at Interactive Brokers and IBKRcampus.com. Follow us on your favorite podcast network and feel free to leave us a rating or review. Thanks for listening, everyone.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.